Hey guys, when the term investments is mentioned, the stock market often comes to mind in the first place. However, it's crucial to recognize that the realm of wealth accumulation encompasses more than just the stock market. While the stock market undeniably holds a prominent position in investment strategies, it's important to acknowledge the diverse array of opportunities available to foster financial growth. But before this video, guys, please like this video and subscribe to my channel as it keeps me motivated to create these videos for you guys. Now, here are 7 ways to invest besides the stock market. The first one is real estate investment trust. If you lean towards real estate investments but find yourself lacking the necessary capital to acquire an income-generating property, or perhaps face constraints in terms of time and research capabilities to identify optimal real estate markets and assets, there is a viable alternative: real estate investment trust. These entities operate on the principle of enabling individuals to participate in the real estate market without the need for direct property ownership. Rather than purchasing physical properties, REITs engage in the acquisition of sizable income-generating properties. The earnings generated from these properties are subsequently shared among the individuals who have invested in this trust. REITs offer an attractive proposition for individuals seeking exposure to the real estate sector without the inherent challenges of managing properties directly. By pooling funds from various investors, REITs gain access to substantial real estate assets, which can encompass a diverse area of properties such as office buildings, shopping centers, apartments, and more. The dividends derived from the rental income and capital appreciation of these properties are then shared among the investors, providing them with a slice of the real estate market's potential financial rewards. The second one is gold, silver, and other commodities. Certain commodities such as gold and silver are often promoted as investments that possess a degree of resistance to inflation. Notably, silver holds a distinct position due to its potential to thrive during periods of robust industrial activity, owing to its widespread application in the manufacturing sector. Although both gold and silver offer the tangible advantage of being physical assets that can be held, their value can be subject to significant fluctuations. Thus, it's crucial to exercise caution and avoid overemphasizing on these commodities within your portfolio. The concept of commodities serving as a hedge against inflation stems from their intrinsic value and the fundamental demand for them across various industries. Silver's dual role as an industrial material and a store of value give it a unique dynamic in investment landscapes. During economic upswings, when industrial production is on the rise, the demand for silver tends to surge, potentially bolstering its worth. In the pursuit of a diversified portfolio, the inclusion of assets like gold and silver can provide a layer of protection against economic uncertainties. Nevertheless, due diligence should be exercised to prevent overexposure to their price swings. A well-thought-out investment strategy should encompass a spectrum of assets, including equities, bonds, and other commodities, to mitigate risk and enhance the potential for consistent returns. The third one is bonds. Governments require financial resources to support vital community initiatives, presenting an avenue for you to partake in investment endeavors that usually carry a degree of security against default. These investment instruments are commonly referred as bonds, and their purpose lies in funding essential projects such as educational institutions, transportation networks like highways, and a diverse array of other infrastructural developments. Although municipal bonds are associated with relatively modest interest rates, it's imperative to recognize that certain variations of these bonds offer an added incentive by being exempt from state, local, and federal taxes. The symbiotic relationship between investors and governments is the cornerstone of the bond market. The appeal of bonds lies in their reputation for stability, as governments tend to prioritize the repayment of these obligations. While the interest rates on bonds may not be as enticing as those offered by riskier assets, The potential for steady income and tax advantages can render them as integral component of a diversified investment strategy. Another one is cryptocurrency. Cryptocurrencies are subject to substantial and abrupt fluctuations in their prices, yet a lot of investors persist in allocating funds to Bitcoin and other alternative cryptocurrencies. However, this form of digital currency is unsuitable for those individuals who prioritize a more conservative approach to maintaining a low-risk investment portfolio. Investing in cryptocurrencies presents a thrilling opportunity. The values of digital assets like Bitcoin can experience astonishing shifts within short spans of time, owing to a multitude of factors including market sentiment, regulatory developments, technological advancements, and macroeconomic trends. While the potential for extraordinary gains is certainly alluring, the heightened volatility is equally noteworthy, which can potentially lead to significant losses. Those who opt for cryptocurrency investments tend to have an appetite for risk. While traditional investment vehicles such as stocks and bonds are typically characterized by comparatively stable performance, the landscape of cryptocurrencies deviates from this norm. It's crucial for prospective investors to be well informed about the unique dynamics of this domain and to allocate funds that they can afford to lose without impacting their financial well-being. Another one is certificates of deposit. Investing in certificates of deposit generally provides the advantage of a superior interest rate when compared to a standard savings account, all while bypassing the potential vulnerabilities linked with the stock market. When you choose to invest funds in a CD, you are essentially opening a bank account with an assured interest rate. This assures you that your principal sum will be returned along with the interest earned over time. The appeal of this investment option lies in the certainty it offers, given the predetermined nature of the interest rate and the guarantee of principal repayment. However, there is a caveat to consider. The interest acquires only within a specified time frame, and if you decide to withdraw your funds prior to the term's completion, you could find yourself facing penalties. CDs cater to those who prioritize a measured approach to wealth preservation and growth. They are particularly well suited for individuals who are risk-averse and prefer an investment vehicles that ensure a degree of security while generating better returns than traditional savings accounts. The fixed interest rate eliminates the unpredictability associated with market fluctuations, providing investors with a predictable trajectory for their investment. Another one is money market funds. If you are seeking an investment vehicle that offers greater liquidity compared to certificates of deposit or bonds, money market funds present a viable and advantageous choice. These funds encompass a blend of short-term CDs and short-term bonds, providing an appealing aspect of flexibility by allowing you to withdraw your funds at your convenience without incurring any penalties. Money market funds offer a favorable compromise between accessibility and potential returns. Their composition of short-term financial instruments ensures that your investment is not locked up for extended periods, granting you the freedom to access your funds as needed. This dynamic makes them particularly suitable for individuals who prioritize liquidity while still seeking relatively better interest rates compared to standard savings accounts. The ease of access to funds and the absence of penalties for withdrawals make money market funds an attractive alternative for those who require financial flexibility. Another one is peer-to-peer lending. Platforms like Lending Club provide an avenue for individuals to engage in peer-to-peer lending services, where you have the opportunity to invest modest sums of money into loans extended to fellow individuals. This modern investment approach enables you to participate with small contributions, and in return, you receive your invested amount along with interest payments. While this prospect offers the potential for returns, it's important to acknowledge that these investments entail a certain level of risk due to the possibility of borrowers defaulting on their loans. However, a strategy that involves diversifying your investment across numerous loans can serve as a risk mitigation tactic. Even if a portion of the loans does experience default, the diversity of your investments could still yield a positive overall return. Well, I hope this video was helpful for you guys. Guys, do you know any other things to invest in other than stock market? Leave your comments down below. So guys, if you like this video, please press thumbs up and subscribe to my channel, as it keeps me motivated to create these videos for you guys. Thank you for watching and see you in the next video.